Welcome back. New Canadian inflation numbers were released this morning. They showed that inflation in Canada slowed to an annual pace of 1.8% in December. The new numbers this morning showed a decrease from November's 1.9% level and were below what economists were expecting as well. Let's talk about it. For a deeper dive into the numbers, we're now joined by Nathan Janzen, Assistant Chief Economist at RBC Economics Research. Nathan, thanks a lot for joining us. One material influence on this morning's numbers, of course, was the GST, HST holiday as it applied in December. What would the numbers look like if we looked through that, if we consider that to be a temporary one-time factor? What would underlying inflation have looked like?
Yeah, so actually excluding that impact of the drop in taxes in December, inflation actually would have picked up a little bit on a year-over-year basis to just slightly above a 2% rate from about 1.7% in November. So still running around the Bank of Canada's target rate, but actually a little bit higher. So different than what we're seeing in the headline numbers. And I think that's really what people were watching ahead of the numbers today. We knew there was going to be a lot of volatility due to this. It was going to be very difficult to predict price changes given the kind of abnormal tax movements during December, but excluding those tax changes, inflation was actually a little firmer probably than expected.
But still within the bank's target range, of course, and also sub 2%. So clearly the Bank of Canada has now won its fight against inflation. The issue now is a slowing Canadian economy. That's why the bank has lowered interest rates. So what is your take on the strength of the Canadian economy right now?
Yeah, I think that's exactly it, and not so much the strength of the economy as much as the lack thereof. The economy has been pretty weak, so we're one of the few advanced economies in the world where the unemployment rate is substantially above pre-pandemic levels in Canada. And I think that's right in terms of framing the recent inflation numbers. Even with a little tick higher in December, excluding indirect taxes, price growth is still right around the Bank of Canada's target rate. And if you look at the survey data that was released earlier this week from the Bank of Canada, from the Business Outlook survey, and also the Consumer survey that they do quarterly, inflation expectations are still moving lower rather than higher. So with the economy weak, we probably have a negative output gap in Canada, the unemployment rate higher than normal. All else equal, you would expect that risks on inflation are really tilted to the downside rather than the upside. Once you look through some of the monthly wiggles in what's pretty volatile data.
What does economic history tell us about the effectiveness of interest rate cuts in stimulating economic growth, and what type of lag period is involved? When the Bank of Canada was raising rates to combat inflation, the point was often made that a rate increase today may take a year to 18 months before it starts exerting a restraining effect on prices in the economy. Same question about rate cuts. How long do they take to take effect, and how effective are they?
Yeah, it would be a similar relationship, and it's very difficult to nail down how long that takes. But in general, you would expect it to take a year, 18 months before you start really feeling the impact of interest rates today on economic growth, and then ultimately inflation also lags economic growth. So there's significant lags between when central banks start cutting interest rates and when you would start to expect to see inflation start to respond. And it's also important to talk about where you are in terms of the interest rate cycle matters. The Bank of Canada, the overnight rate is still at the very top end of the range that they would view as having a neutral impact on GDP growth and inflation. So to date, all the Bank of Canada has done really is ease off the monetary policy brakes in terms of the forward-looking outlook for inflation. They haven't yet moved to a quote-unquote stimulative level of interest rates that eventually would cause growth to strengthen to a pace that's strong enough to start bringing the unemployment rate down and ultimately inflation up.
If you and I speak a couple of months from now, it's quite possible we'll be speaking about the effect of a tariff war between the two countries, Canada and the U.S., on the Canadian economy. What are RBC's thoughts at this point on that topic?
Yeah, I mean, absolutely. It's a significant risk for the Canadian economy. The North American industrial supply chain is kind of unique in a way globally, where trade flows are, and industrial production chains are incredibly closely integrated across the Canada-U.S. border and also the Mexico-U.S. border. So tariffs are a tax on trade flows, not on production. And so if you put a tax on industries that have very high trade flows relative to their production base, it effectively can be a significantly larger effective tax on production, both in Canada and Mexico, for the same level of tariff rate, relative to if you impose the same level of tariff rate on say, China versus here. So even small tariff rates can have a significant impact on those industrial supply chains, and they can raise costs. In terms of the inflation outlook for Canada, we would think, potentially you could get some near-term increases in prices as those costs, filter through relatively quickly to household buying costs, both in the U.S. and in Canada. But ultimately, the impact of most of those scenarios is potentially significantly higher Canadian unemployment, weaker GDP, and ultimately, actually, those factors are probably disinflationary beyond any short-run, immediate near-term impact from tariff hikes.
Nathan, thank you a great deal for your